Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Krommendyk of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Welcome back to the second half of our ENT meeting with Rich Ericson with A-Link, brokerage captive insurance company. And with me is Jeff Krommendyk with Security First Insurance. Hey,
Hello,
Jeff.
Mike. Thanks for having me.
Nate Merrill with Goodspeed and Merrill with us.
I'm back once again as well.
Like a bad rash.
I thought you weren't going to go there.
And myself, Mike Miller with Miller and Associates CPAs. Continuing from our prior podcast, Rich, you have some coaching background that you want to tell us about.
It's true. Thanks for asking. And it reminds me of how old or young I am, because I was mentioning that...
So is Gerald Ford as good as we think he was?
Oh my.
I am old, but not that old.
Leather helmet.
Right.
No, I was fortunate enough to play college football at Weber State University in Utah. And when I finished my education there, I coached football there at Weber State and at Utah State University. So I, for a living, coached college football. I was the offensive coordinator at those schools.
Awesome.
Wasn't there some noble distinction, though, like youngest something or the other?
At the time, I was I was probably the youngest offensive coordinator in the country at that time.
Wow.
That's a big deal.
Yeah,
That's
awesome.
impressive.
So what position did you play in college when you were playing football?
I was a quarterback.
Okay, all right.
Not good enough, but I played with some guys that played in the NFL. And actually one of them, Jeff Carlson, he wouldn't be well known in this area, but he actually ended his career here with the Denver Broncos.
Yeah.
And
What position was he?
he was a quarterback.
Okay.
And then Jamie Martin, I played with and then coached him. And he had a 15-year NFL career as a backup.
Nice.
Yeah.
So it's kind of fun.
Yeah. Awesome.
My claim to fame on football, and I'll date myself here for our listeners, is I played JAA football in Georgia. And I had one game where we played Herschel Walker.
Yeah.
And we were warned that, hey, they're going to pitch the ball to this kid, and he's going to run around the end, and that's all they do. And
He's going to run over you.
We couldn't stop them, and they beat us like 72-0.
Yeah. So my kids are mostly grown. I still have a teenager, and I don't watch and participate in football nearly as much as I used to. Excuse me, but I will say, because everybody knows Mike Zimmer, the head coach of the Minnesota Vikings. When I was in high school, he was a position coach that recruited me. And so in my older age, that's how I watch football now, is with people that I know or knew in the industry. And so I follow, of course I follow the Broncos, but I follow Mike Zimmer and the Vikings because I know him.
Yeah.
Well, football is a logical segue to captive insurance. I can totally see how you came into that then.
Lloyd's of London and us are a little different.
Right.
There you go.
So go ahead.
I was going to say, so Rich, we left off with, what the ideal business was with our last podcast. I think you went through 3.
You left a big teaser for us.
Left a big teaser for us. Yeah.
Yes.
Wanted to continue on with the big tease.
I wonder if it has to do with health insurance.
Nobody wants to deal with health insurance these days.
Huh. Okay. Well, take it away.
Okay. Let me quickly review, and I can do it in 30 seconds or less for new listeners. Let me explain the ideal client to own a captive insurance company. And there's 3 matrices that can quickly and easily be identified. A client does not have to qualify in all of these areas, but in any one of these, and oftentimes they do lap over one another. Number 1, a profitable, privately owned company grossing $20 to $100 million. Number 2, an operating company that pays close to $1 million or more in traditional P&C lines of coverage. And number 3, which is what we're going to spend a little bit of time about, is a simple question, is any company that has 100 employees or more. They're a perfect candidate for captive insurance.
So the first 2, based on our previous discussion, are kind of obvious. You know, a high-grossing company getting business interruption or income interruption coverages, obviously that makes sense. Insurance streamlining opportunity for someone who pays a lot of premium, that makes sense. What does employees have to do with a captive?
Again, it's so exciting because it's a non-disruptive way and therefore a very simple entry point to captive insurance. For companies that have 100, I'll just use the number 100, and it, like I've said, it could be smaller, it could be larger. But once a company has 100 employees, they typically should be self-funded on their medical benefit plan. There's exceptions, but as a general rule, once a company hits that mark, it is very cost efficient to be self-funded in their medical benefits.
And self-funded just meaning basically self-insured, that they underwrite their risk and reserve for possibility of risks, or
not wanting to be an expert in the medical self-funded field, it's more than that. Actually, self-funded just takes all the components of a fully funded plan and breaks them apart and shops them and therefore creates more ownership, more transparency, more accessibility, and ultimately significant cost savings for the operation.
So it's not having no insurance, it's probably just creating strata of risk that you're insuring differently.
That's right.
High retentions, deductibles, things like that.
Yeah, all those things.
Stop losses.
Everybody understands their medical benefits. Hey, we have you mentioned it, there's an administrator, there's a TPA for that. There's, hey, how do we access prescriptions? How do we control the risk? Yeah, there's the network. Do we want United Healthcare? Do we want Cigna? Do we want Anthem? Whoever. There's lots of networks, and they're wonderful. And by the way, they're insurance companies, and they're very, very profitable. Remember that. And not to disparage them, but how about redirecting some of those premiums that you're currently paying in medical benefits to your own pocket? That's what a captive does, and that's what, there's a process. I wrote a brief article called Good, Better, Best that's accessible, willing to share that with everybody. Once a company hits 100 employees, they should look at being self-funded. With that comes some exposure. So to control that exposure and risk, as part of that plan, there's stop loss. So, and there's specific and aggregate stop loss, and don't let me get into the weeds here. However, when an employee has cancer, a company is not going to be on the hook for that employee if it costs them hundreds and hundreds of thousands of dollars. They file a claim against their stop loss.
It's the fear of that sort of thing that usually drives people away from doing self-funded, right?
Yes.
Yeah. So, let's break the risks down to kind of pull you back out of the weeds. So at an entry level, we're all familiar with like office visits, like you say, and some of the more early out-of-pocket costs, preventative care, that sort of thing. So how does that factor into this structure?
Into a self-funded plan, everything that a fully funded plan has, a self-funded plan has. And it's that simple.
But that's usually not an insured per se type of exposure.
No, you're paying United. I don't want to get anybody in trouble. I love United Healthcare, but I'll use them as our example.
Acme Insurance.
Acme Insurance. Great. We pay our premiums, the employer and the employees combined pay Acme Insurance. Once they have 100 employees or more on the plan, they're paying millions of dollars to Acme Insurance. And then Acme provides all these benefits and covers those exposures.
Right. But in a self-insured plan, you're not paying that premium per se to Acme anymore.
That's right.
But you're reserving on your balance sheet as a business owner enough to cover those doctor's visits.
Yeah,
and those
you still have a network, and you still have prescriptions, and you still have stop loss. You have all the components just separately.
So I'm going to now introduce something new. Now a new level of risk beyond preventative care and kind of the easy stuff to quantify and cover is Johnny breaking his leg or Susie,
Yes.
Or the
Not a runny
premature
nose,
babies,
but
right?
There's more costs involved.
Emergency surgery.
Emergency surgery, all these things that are real for every business. And once we have 100 employees, the law of numbers, probability says we will have those costs and expenses, and that's okay. That's good.
So where do you usually see the break points in terms of reserved risk to kind of moving
Yeah.
up to the next level of risk?
So typically, a self-funded company, they have to have a stop-loss policy in place, and they'll put that in, and I'll just, for simple example, suggest that they put it in starting at $100,000. So the company is responsible for all claims from zero, from a runny nose doctor visit, all the way up to $100,000, that emergency pregnancy or emergency room visit. And then once a claim or an event is over $100,000, then there's insurance for that through the stop-loss policy. Fantastic. That's good. It's efficient.
So even self-insured plans,
Even self-funded plans, they
have
that
insurance, right?
They have that insurance in place, and they should continue to do that.
And are these done typically in a group captive environment?
Nope, I haven't even had the opportunity to get to the captive part.
That's just self-insured.
That's just
Okay, that's just
self-funded.
okay.
Self-insured or partially self-funded medical benefit plans, and they're everywhere. They're all around us. That protects the employees and the employer by having these different components, and specifically the stop loss. So if somebody gets leukemia and
that's where I was going next,
Yeah.
was the kind of higher level risks.
the aggregate. So
you're-
it doesn't, whatever that may be, it may be $1 million over the next year because of the complexities of
chemotherapy and radiation.
Yeah, all of the.
I mean, those are your really extreme exposures.
That's right.
Beyond the breaking legs or the premature babies. It's when you're in ICU for an extended period of time or under some
Correct.
sort of drug program that costs.
Yeah, all of those things combined. And the medication to deal with that. So those expenses are covered for a self-funded plan by their catastrophic stop-loss coverage from $100,000 on up to whatever.
So how does one use a captive insurance company
Thank
to
you.
really maximize their
Yeah.
self-funded plan?
So for those companies and business owners that are already self-funded, they understand that they're responsible for that level that I mentioned from $0 to $100,000. What we're able to do is take a layer of that, and for example, let's say we take the layer from $25,000 to $100,000 and insure that in their captive. And so what we're doing is we're prepaying that in the event that there's a claim at that level. So Johnny breaks his arm and it costs $30,000, great. That does not change or threaten the existing plan. But now, because of captive insurance, we've been able to pre-fund a layer or all of the captive insurance for that medical stop loss. And what is not claimed is retained by the business.
Right. But there's an accounting rule that would eventually have the company re-recognize some of its reserves back into revenue. So at some point, if insurance reserves aren't used in a self-insured plan, they have to be recognized back into revenue. By putting those revenues that you would expect to eventually roll over into a captive, you never have to re-recognize that revenue back in. So it's an expense that's gone out and it's gone.
Yeah. So let me expound on that just briefly. If a company is self-funded without a captive, they are responsible for those claims from $0 to $100,000. I've repeated that several times, but they're real conservative, and their broker trained them well, and so they set aside $1 million to reserve for those claims in that level.
Actuaries help with that whole calculation.
Not yet. No captive. Just they set it aside because we can look at their claims loss,
right?
And
their history and that sort of thing.
Their broker will help identify. Hey, you have this many people. Last year you had this many claims in this threshold. 2 years ago you had more claims. So they reserve $1 million. They paid out, let's say, $100,000 in claims. And as Nate just mentioned, now at the end of the year, without a captive, they've got to recognize that $900,000 back to the operating company. And by the way, then once they do that, then it's taxed inside their structure. With a captive insurance company, and it's actuarially underwritten, but they set aside that same $1 million. Now they still pay $100,000 in claims when a claim happens. And we don't know how much that will be each year. But now that $900,000 sits in their captive insurance company, and it's very efficient to do that from a tax perspective and from a wealth accumulation standpoint, and from the non-disruptive way of implementing that in their captive insurance company to ensure that layer of exposure in their captive. Additionally, what that does is it gives the owner more control and more flexibility of A, their captive insurance company, B, those assets, and C, the exposure that they're insuring there.
So just, and this may be beyond the scope of this conversation, if so, just
nothing's
tell me.
beyond the scope
We'll
of
move
this
on.
conversation.
So let's say they've set aside that $1 million and it's just sitting there, it's an asset of that captive.
Yes, they can buy a Lamborghini.
And at some point the business just ceases to exist because they just didn't want to do it anymore. What happens to the money that's sitting in the captive?
Great question. There's exit of the captive. It's shut down, and ultimately they have their asset, and it's for simplicity, it's distributed to them in a tax favorable way. It's taxed at long-term.
Keep in mind that
capital
the
gains
captive
rate.
is a separate business. So it's not, it doesn't, generally speaking, it can be under the operating business, and there's a lot of considerations that go in there. But this captive could be owned in a dynastic trust by the grandkids or something like that too. So two ends of the spectrum. It could be integrated with the business unit, or it could completely off balance sheet, shifting wealth. And I'll stop there because if the IRS is listening, that's the part they don't like.
And that's Nate being very creative.
Yes.
No, it's Nate following all the rules and understanding, like I said, the legalities to properly structure for not only implementation, but for maintenance and ultimately for the exit of that company.
Asset protection.
And the assets in it. Yeah, so those assets are protected from creditors and predators and other things that I just mentioned.
So real quick to just clarify, once a captive is set up, they can use the same captive for their property and casualty needs as well as their health insurance exposures.
Yes, that is correct.
So it's not a separate captive.
It can be, but it doesn't have to be. Typically, a captive that if it's just insuring medical stop loss, well, that's perfectly appropriate because a company has 1,000 employees, and that's the underwritten exposure of that. Maybe the company only has 100 employees, and so that premium is written at $1 million, but the limits of the captive is $2.3 million, so we'll put in $1 million of medical stop loss, and then we'll add to the exposures that they're insuring. And it may be the low frequency, high severity exposures. It may be deductible reimbursement. It may be all the things that we've talked about.
But going
in the
back to
past.
our discussion of what makes an insurance company, there's the risk distribution piece. And this is where we can leverage the diversity of 100 employees
Yes.
and that $1 million of premium to eliminate some of the other structures that sometimes have to be. You can be a standalone insurance company because you now have risk distribution across a very broad pool of insureds.
That's correct. And what that is considered, medical stop loss, is third-party risk, because the owners of the insurance company aren't in control when Johnny breaks his arm and goes to the emergency room. Therefore, that passes the test
Of third-party
of
risk.
third-party risk.
As long as they don't have more than 50%
That's correct.
of, not third-party risk. So as long as that third-party risk is 50% or more of the premium.
Yes. And it doesn't have to just be medical stop loss. There's lots of different third-party exposures. Once we do get into workman's comp, we get into property management, we get into warranties, we get into, again, I'll get sidetracked because there's so many opportunities regardless
So for example,
of the industry.
I'll just use one that, just as an easy, this probably won't be too many people out there, but a private equity firm that has a portfolio of 10 to 12 different companies, each of those companies is an individualized risk. And so the private equity could conceivably set up a captive to provide insurance to its portfolio companies.
And by doing that, they are transferring risk and therefore don't have to pool that risk with other companies. They can if they choose, but they don't have to.
So the three criteria that you gave us at the beginning of this podcast show and at the end of the last one, specifically around revenue being around 20 to 100 million.
Mm-hmm.
The other one being around risk transfer expenses, insurance in particular, overhead being around $1 million a year.
Mm-hmm.
And then the third one being around 100 employees. Is that for a single member captive, or are those the guidelines that you would also use in a group type captive setting, meaning several companies in one captive?
Right. So depending on the administrator that we work with, the pooling arrangement may vary and the exposures may vary. And that the variance of geography as well as exposure adds diversification there and safety for people that belong to that pool.
Right.
However, business owners, my experience is they love to be in control, as they should, and they don't like to pool. It costs money to pool, 2.5% of premium to be exact, and that's pretty significant when it's $1 million, $2 million, et cetera. So by controlling and managing their own risk and not having to share it, that's very attractive to business owners.
However, the entry point into a group captive could be lower, meaning revenues could be
Correct,
lower.
yes.
Insurance premiums that you're paying, that would potentially be a lower entry point into a group. And then you may maybe 20, 25, maybe 30 employees could be potentially.
I'll give you an example of a client that I'm working with right now. They are part of a captive right now that provides insurance for them. They know that, but they don't participate in the ownership. So they get the protection. To me, that's the exact same as paying a premium to a third party. What's the benefit of it?
Right.
So my discussion is, okay, great. That's not wrong. That's not a bad model. And in fact, if, to your point, if they can't afford to pay that premium themselves, they're just paying a third party, that's fine. However, it's much more attractive for a business owner to pay premiums to themselves legally.
Well, and,
protecting
that gets
themselves.
back to I can't remember if we talked about in this the last episode or not, is, the common misperception when you're first being introduced to a business owner is that you're selling insurance. How do you respond to that?
I'll give you the longer answer, and that is, doesn't everybody love insurance? Doesn't that get everybody excited to pay premiums? But no, we're not selling insurance. We're selling solutions. We're selling a better opportunity to generate a new asset, and premiums create profits for that business. And it's that simple.
So while there's an insurance expense, the
Yes.
business owners always think, well, what am I getting?
It's not a sunk cost.
Right.
Because they're paying premiums to themselves. And typically, we're just redirecting existing premiums that they're already sending out.
And at the end of the day, if they have to distribute those premiums back to themselves, it's long-term capital gains.
That's right. It's favored that way.
Absolutely. And that's where I tend to get real excited, is the tax planning side of this, which is probably a discussion separate and apart from this, because just understanding captives, how they're used, their different components is kind of key to any entry discussion. And then I usually come in later to say, here's how we should structure it. And
Additionally, I'll throw out another teaser, and I won't answer this right now, but the usage of that new pool of assets is fantastic. And it solves problems. So problems that I have solved with my clients are buy-sell agreements, retirement, leasing, creating leasing companies,
financing companies.
Thank you.
Real estate acquisition loans. Yeah.
There's all those things have
Buy a new business.
Thank you. All of
Yeah.
those things have nothing to do with insurance, yet everything is because of captive insurance, because they have this new pool. And people that are searching, I can give you specific examples. Two partners, one's in his 40 years old, one's 60 years old, and they don't know how to buy out the older partner who wants to retire. Captive insurance, because of this new pool of assets. I have another client. They spend all their money and resources into growing their company. They're at retirement age. They don't have any assets, retirement assets. Well, by protecting their operating business, now they've created a new pool, and the owner can retire.
And for another discussion point, maybe a different podcast, all the tax advantages that you can do with your money inside of a captive.
Yeah, I mean that's what what we're essentially talking about here is stage 2 of the captive, the redeployment. Like now you've got this, and it's surprising. We've, as Rich said, this is a relatively young industry in terms of its adoption in the marketplace, and how quickly some of our clients have built up pools of $5-10 million of assets, paying $1 million in premium a year, $1.2 million, $1.5 million, whatever. And now they have this big pool of assets that otherwise would have been held by Treasury, that they can then redeploy in other business ventures. So,
All right.
yeah.
With that,
Exactly. I mean, I'm holding back, not wanting to talk about all the fun, sophisticated, boring, insomnia-curing tax stuff. So we'll wait to actually get called before a prospective listener who's interested in this, and I can bore them with all that other fun stuff. But the tax planning, to Mike's point, that can get woven into this, between income tax efficiencies, estate tax efficiencies, asset protection, the whole 9 yards, it all rolls into this. Rich gets really excited about it because it's such a flexible and leverageable, if that's a word, solution. There's so many ways. It's not just insurance that you can use it to solve those other problems, that it gets really exciting.
Whenever we start talking about captive insurance and start delving into all these cool and exciting and fun things, just remember it's insurance. First, last, and always, it is simply insurance. And once you remember that, then we can have all sorts of fun in showing you how it can benefit your business. and what you can do with that new asset and how you can protect your business and this and that and the other. And then we'll get a little confused and into the weeds just a little bit. And when we do, just say, wait a minute, this is just insurance. I pay premium to my own insurance company to protect my operating company. That's first, last, and always, that's all it is. And that
Very
is
profitable insurance
very
company.
profitable, just like other insurance companies that are out there, but it is your insurance company.
Well, that really simplifies it right there, I think. That's easy.
It's just insurance.
That's right. All right. Well, great. Rich, it is really a pleasure to meet you. Thank you for joining us today and on our last podcast as well. Nate, it's always a pleasure.
I was going to say.
But
I didn't want another rash joke in there, but
Mike and I are glad to have kind of sat on the outside watching you guys go at it here today. And thanks for all the information you brought. So
absolutely.
Thanks for having me.
Thank you for joining us today. Hope you enjoyed the information we shared.
if you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.